Hi traders, welcome to a new educational video. I'm going to be talking about cumulative volume delta, one of the most important order flow indicators that I use in my day trading for the ES and the NQ markets. We're going to go over what delta is, how it's calculated, and then we're going to see how cumulative volume delta is represented on the chart and how it is used in day trading and it can help you in your own strategies. Okay, so first let's go into some definitions. What is delta? So delta represents the difference between executed orders at the bid and the offer. We take the total aggressive buy orders minus total aggressive sell orders. And by aggressive orders, we mean orders that were market executions. Delta gives better information than liquidity. By liquidity, we mean just the resting orders in the book or level 2 data, because delta shows us the real orders that went through. Whereas limit orders on the DOM are constantly changing, they're pulling, stacking, and it can be used to confuse or mislead traders with spoofing, iceberg orders, etc. Okay, so ways to represent delta. Delta can be represented in various ways, such as footprint delta, delta volume profiles, and as we will see in this video, cumulative volume. The cumulative volume delta, or CVD, is represented as a candlestick chart under the main price graph, and this type of delta is especially useful to spot divergences because you can compare directly price versus what the aggressors are doing, and you can then spot divergences as we're gonna go over later in the video. So let's talk briefly about the DOM. So a DOM, or depth of market, is basically where we have also called the price ladder. We have every tick level here. In this case, this is a SP 500 ES DOM. And then we have on the top right, the ask or the limit orders to sell. And then on the bottom left, the bid or the limit orders to buy. Okay. And right here, you can see highlighted, this is where price is executing right now. Okay. Now, if the market only had passive limit participants, it would not move, because basically we would just have people waiting at every price level. This is the amount of contracts that are resting at this moment. But again, a DOM is very dynamic and these levels are constantly changing with orders being added and taken out. Okay. So we need aggressors. We need people that are going to hit that buy button, that buy market or sell market button to make markets move. Also, for example, stop losses on orders. Most of the time, stop loss orders are executed as a market order, because when you have a stop loss and price goes there, that's your invalidation and you just wanted to get out at whatever best price you can get. So like if we have price and it does like this and you went short, normally people are gonna line up all their stop losses right beyond an obvious swing level. Okay, and this is, when people say hunting stops or engineering liquidity, like this is what they mean. If price comes back here and pokes here, all this stop loss protections are going to execute as a market buy, because if you're selling, you need a buy to get out of your trade, the opposite. So all this market buy is getting executed here on this stop loss orders, plus all the aggressive breakout traders that are hitting the market buy because they think it's going to continue. If there is a very large passive trader here that's consistently replenishing and reloading big limit orders, is just going to start using all this aggressive buy orders to load up on shorts, and then it can push down the market again, okay? Obviously, you know, this can also be a genuine breakout and it's just going to liquidate the stop losses here, but the buy pressure might be enough to take it through. But what I'm trying to just get at with this is that we need aggressive order executions in order for the markets to move, okay? And so that's why, you know, if you're here and you want a market buy, you're gonna lift the offer, so you're gonna get filled at the next available level. If you wanna go short with a market order, you're going to go down, and you know, depending the size of your order, if you're only doing 1 or 2 contracts, you're just gonna get filled at the next available level here. We got 26 resting limit buys, but you know, if you execute 30 market sell orders at once, then you're going to clear this level and you're going to get some slippage, and you're going to get you know, short somewhere around the 33.25 area, for example. Okay, but let's go now and see how can we calculate delta. So over here I have 2 footprint charts, which is, this is the easiest way to show how to calculate it. I have on the, this is, both are a 5-minute candlesticks on the E-mini S&P. This is a bid by ask footprint. So we have on the left aggressive executions to sell, and on the right aggressive executions to buy, okay? And then on the right side, this is how I personally like to use my footprint, volume by delta. So this is the total contracts traded and the delta at each price level. So how do we calculate it? Very easily. We just take the bid and the ask, and since the ask is the aggressive buys, we're just going to subtract the ask. We're just going to do ask minus bid. So in this case, we have -3. And you can see here we have a -3 delta on this level. And this number here, if we add up all the executions at this tick level, this is going to give us the total contracts that went through at that price level. And we just do that for every single level. Right here you can see 262 aggressive buys minus 180 executed sells. We have a delta positive of 82 at this price level and a total volume of 442. Okay, so we just go doing this for every price level, and here's the total volume for the candle. So if we add up all these numbers, this is the total volume that traded in this candlestick of 5 minutes. And if we add up all the deltas that we have from doing all these calculations, we're going to have a total delta of -288 on this candlestick, okay? And this is obviously a bearish candlesticks, and we have a bearish delta. This is not always the case. As we're going to see later, there's sometimes what we call individual candle divergences, where we have a positive candle, a green candle, with a red delta, or vice versa. Those are good signals of absorption, okay? And this is an example just on a bullish, a green candle, bid by ask. So we have 7 buys executed, 0 sells at the top. So 7 minus 0, 7 positive delta here. Next one, 159 minus 32, 127 positive delta, total volume 191, etc. And then we just go doing this at every price level. We add up all the deltas, and that's going to give us the total delta for the candle. And right here, the total volumes for the candle if we add up all the numbers. Okay? So now that we've covered that, Now let's go into the charts. So here we have an ES S&P chart. This is a 3000 tick chart. I prefer to use tick charts when I day trade because it filters out a lot better the volatility and high volumes that come during regular trading hours versus looking at a time-based chart. But obviously this, you can do it, you can use it on a 1 minute, 5 minute, or whatever chart you want. I will say this is useful on lower time frames. I don't really think you would want to be looking at this on like a 1 hour time frame. This is most useful to spot short-term divergences. So as you can see, on the top we have the price chart. On the bottom we have cumulative volume delta. Now, if I bring this down, I have another indicator here. This is on TradingView, okay? And you can check out my SierraChartTemplates.com website if you want to get pre-made templates that I have similar to all these ones. You can go check all those out if you want. And here, what this indicator is called the Ask-Bid Volume Difference Bar. So basically, this is plotting the delta candlestick for every corresponding candlestick on the chart, okay? But instead of putting them all together one after the other like cumulative delta, is just placing them on a from a zero axis and just measuring how much the delta was to the upside or to the downside, okay? So what cumulative delta does is it takes all these deltas and starts plotting them like if it was a candlestick chart. So where a candle closes, the next one starts, and it starts adding them up. So if you go here, let me just get rid of, let me get rid of this one for now. So you can see right here, this is 9:30 a.m. So this is the start of the regular trading hours. And as you can see, delta is starting right at 0. I have this set the way I like to use it. As you can see, every session at the beginning, this is extended hours at 6 p.m. As soon as a session starts, delta will reset to 0, and then it'll start accumulating throughout the whole session. And so you can see, as deltas go up, it starts going up on the delta scale here. Then we start having delta coming down, etc. And then by the end of the session, which in this case we ended up closing the day here, you can see that we ended up pretty positive, like right around like an 8,200 positive delta for the day. So that means there was a lot of aggressive market participants that day. Okay, so that's pretty much how it is plotted. So we have the price chart and we have delta. So now let's start talking about the ways that delta is going to be useful. This purple line, by the way, this is just VWAP, but this is we're not going to cover this in this video. Again, if you want more in-depth strategies of all these things I'm talking about, definitely check out my trading courses, especially the Orderflow and Volume Profile trading course. So let's start off first with the regular divergences, okay? A regular divergence is just like when you started learning things like MACD or RSI or those things, is basically when price is making higher highs, but the cumulative delta is making lower lows, okay? And then vice versa. Price making lower lows and cumulative delta making lower highs and cumulative delta making higher lows. Okay, so let's go find an example on the chart and show you what a regular divergence would look like. In this next example, this is on that same day. You can see how market was coming down, pulling down here, and yet we're making new lows in the price, but cumulative delta is making higher lows here. So this tells us that there's no aggressive sellers interested to keep selling at this lower levels. So this is a signal that we can have a reversal coming up as the aggressive buyers are showing that they are continuing to push price. And you can see eventually we do have this pop up, and then we have a nice reversal going on over here. Now, I will say, this is not a perfect science where it's always going to be really similar in lockstep. There are moments where, or even sessions where price and delta are diverging for like most of the session. And those days, you're going to be using cumulative delta again as one of the confluence factors. But like, for example, you can see this day here, we had delta pretty much sideways all through this part, and limit orders were pretty much just in control, pushing and pushing and pushing prices up. Then like here, you can see we have this retracement, but delta was highly, highly negative. And you can see just the huge divergence that we have of price going up versus delta compared to the open of the day, just making lower lows there towards the end of the session. So there are days, especially days like this, where market is just grinding and grinding nonstop, higher or lower, where you are going to experience that you're going to have just a lot of divergences for an extended period of time. So in those cases, you can't just rely blindly on what the CVD is telling you. Now, one more divergence type that I just want to mention in this video is the individual bar divergence. What that means is what we talked about earlier, where we have a green or red candlestick chart with a opposite delta. So if I go into a volume by delta footprint chart, you can see examples. For example, this candle right over here. We have a couple of examples. This would printed a very bullish pin bar candle with a minus 328 negative delta. What that means is you can see at the bottom, we have a lot of aggressive sellers trapped at the bottom, and that helped to fuel this push up. Here's another bullish divergence. So that is another thing that you can look for on the chart. Now, I will say, with this, you just gotta be cautious because it doesn't mean instantly if you see one of these divergences that that's a signal to buy or sell. Context is very, very important when it comes to all of this. You want to be positioned with the overall trend. I use all my volume profile levels as well. Price action, my historical, daily, hourly, support resistances, VWAP, etc. It all comes together into one, big strategy, and you're just trying to check off as much confirmations as possible. So this divergence, you can see by this highlights on the screen, red and green. This is highlighting every divergence that we have on this session. So you can see there's a lot of signals of divergence. Some are going to be not really useful. Other ones are going to be, will give you some good signals. For example, the one we saw, this is by far the best example that we see on the chart. Here we have two divergence candles coming off right here. You can see we pushed down right into VWAP, and we actually had the price pretty much making equal lows, and delta is very highly negative, the cumulative delta. So this indicates there's absorption going on from all these aggressive sellers. You can see how far down, look at where delta, like price is here compared to delta. Okay, so there's a lot of pressure of aggressive sellers, and yet price is not breaking down. That is a clear signal that we have big limit participant absorption to the upside. And then we have this individual candlestick divergences near a very key level where we have VWAP, and we also have a very nice high volume node, and we're right around the low volume node areas. Previous support broken, resistance back to support, and we're back to testing that area. So all this was a nice confluence of signals to indicate that the market intention here is just to keep pushing to the upside. Okay, that's pretty much it for the video. Hope this has been insightful. Again, if you want to learn more in-depth strategies about using all these tools, definitely check out my trading courses in the video description. Also, if you want to check out my custom Sierra chart templates, you can do so over there. I hope you've learned something new today and that you're gonna consider using cumulative volume delta. I think one of the most valuable order flow indicators that you can be using, especially in the futures market. Okay, with that, I'll leave you. Take care, leave a like, any comments below, and I'll see you in the next one. Take care.